Hello everyone, welcome back to ESENtaxa. Andrea Papito here, and in today's video we are going to compare the high net worth individual tax regime, the Italian high net worth individual tax regime, with the Greek high net worth individual tax regime. And here we are moving forward with a series of videos in which we compare this Italian tax regime with the rest of the countries in Europe. In the previous video we have compared Italy with UK, with the not dumb UK tax regime, and now we're going to compare the same regime with Greece, because apparently Greece makes something very similar with Italy, so they sort of copy and paste the tax regime. But we're going to understand in this video if Greece is better or is not better than Italy, okay? Just want to remind you quickly that if you're in this channel, ESENtaxa talks about how to optimize your taxation, how to find the tax strategies before relocating to a specific country, and we help people to understand if the tax burden in that specific country can be optimized, can be squeezed, can be reduced, exploiting a certain number of tax regimes that in most of the cases are not visible, are not well known, or just brand new. And all around the internet, browsing the net, the informations are confusing, are not precise, and who knows that all the details are hidden, or there is a saying that the devil is hidden in the details. Okay, so it's very important to be to be sure about certain laws, certain details in a specific country. And here in ESENtaxa we are the #1 channel in English language that explain the Italian tax system, regulation, tax schemes, and help people to relocate in this country. In the description below the video you will have our email contact, info@esentaxa.com, and our calendar link if you wish to have a consultancy with us, 1 hour, 20 minutes, 2 hours, or if you wish to have also a tax simulation, which is a way to understand in advance the number of tax to pay before moving to a specific country. Now, back to this topic, I want to compare in this board Italy and Greece, okay? Both countries give the opportunity to apply for the high net worth individuals regime, tax regime, and in both cases it's very similar for both countries. In exchange of not seeing your foreign income be subject to the ordinary progressive tax rates, you have to pay 100,000 euro to the Greek state or to the Italian state. So in both cases, paying 100,000 euro, so if 100,000 euro it's a very small amount of money to pay in exchange of seeing all your foreign income not taxed, well, this regime, it's perfectly for you, okay? So which means that if you're earning 1 million euro from foreign sources, 100,000 euro is just 10%. If you're earning 10 million euro, 100,000 euro is just 1%, okay? And the good point about this tax regime is that in both cases you can add your family member with you. So your family member for Italy will pay only 25,000 euro, this is euro always, and in Greece 20,000 euro, okay? So if you ask your partner, if your partner also, he or she is a millionaire, of course 25,000 euro, 20,000 euro, it's almost nothing in terms of taxation, in terms of tax pressure, okay? So it's extremely advantageous if you have a family and each member of a family earns millions of euro outside the Greek border or the Italian border. So up to now, these two tax regimes works exactly the same. The only improvement is that in Greece you pay a little less for the joint family member, and both works for your foreign source of income. So basically, Italy and Greece renounce to tax you on your worldwide income, but they tax you only on your territorial income produced inside their border, and the foreign income, instead of being taxed with ordinary tax rates, will be exempt from taxation, no monitor, no capital gain tax, anything else. In exchange, you pay only 100,000 euro or 20 or 25,000 for your family members. So far so good. Now let's see the other differences. In Italy, you should not have been tax resident in order to apply for this tax regime in the previous 10 years before the relocation, while in Greece it's 8 years, okay? And this regime lasts for 15 years in both countries. Up to now, we can give a little bit more points to Greece. You see you have 20 instead of 25, 8 instead of 10 years. But so far looks like the Greek version of this tax regime, it's better. But if you want to apply for the Greek one, you are also obliged to give 500,000 euro to a Greek bank account, okay? And promise in the next 3 years to invest this amount of money in Greece, in real estate, shares, company, whatever. It basically, you're giving this money to Greece, to the economy of that country. So you're obliged to pay this big fee, while in Italy this is not needed, is not necessary. Okay, so this is a big difference. So apparently look like a little bit better for joining family, for the years that you should not have been tax resident in Greece, but you have this big fee to pay to Greece, basically, to the country, actually, because you're giving to the economy as an investment. In both situations, this is something that also we have analyzed with the UK. In both cases, there is no remittance-based system. Remittance basis doesn't exist. So it means that you can earn this amount of money from abroad and you have all the rights to bring this money back to the country. While for the not done tax regime in UK, you have to pay your ordinary taxation for all the money that you're emitting back in your country. So this also works in the same way. And now, another important thing that we have to consider is that Italy has so we have a look at the disadvantages of the Greek version of this regime. Now let's look at the disadvantages of the Italian version of this regime, which is the capital gain tax of 26%, which is the withholding tax, only applicable in the first 5 years of this regime. So in the first 5 years out of 15, you pay 26% of capital gain tax in Italy, but only on the qualified shares, company shares. What does it mean, qualified company share? Of course, I'm talking about foreign company, always, because otherwise you will pay 26% forever in Italy if you're selling Italian shares. So qualified shares means that you own the majority of the shares, more than 51%, more than 25%. Of a specific company, a foreign company, you sell this percentage to someone else, you realize a capital gains, and in the first 5 years, you will pay 26%. Of course, you can sell your property abroad, all the rest of the things, or if you're not qualified shareholder, you can sell it and you are completely tax-free. So you pay this 26% capital gain tax in the first 5 years only if you are qualified shareholder for foreign shared companies. So it's a very, very restricted situation scenario. But in Italy, there is this thing, while in Greece, this doesn't exist. So, and the rest basically is the same because both tax regimes comes along with the golden visa. So if you want to apply for these tax regimes and you're a high net worth individual, you can apply for a golden visa regime. A golden visa that will allow you to access to Italy on the territorial, stay in Italy as much as you want, and apply for this regime. So the two things comes along together, and for Italy, we can help you with our immigration lawyer partner to apply for this regime and relocate to Italy. Of course, in Italy, there is the possibility to ask in advance to the Italian tax agency if this regime makes sense for you. We provide a service which is called pre-tax advance ruling, which basically we ask a consultation straight to the Italian tax agency, and we can have an advanced response from the Italian tax agency. So basically we transmit a document in which we describe all your situations, where are your companies abroad, from which country you're receiving your income, because this tax regime doesn't work if your country from which you are receiving your income doesn't have a DTA, so the agreement to avoid double taxation with Italy, which is rare because Italy made all the agreement all over the world. So we ask the Italian tax agency if you can benefit from this tax regime. If everything is fine, and if we receive a positive answer, basically you're bound for 15 years in which you're not going to be subject to any tax audit, any control, any checks, because they already give you the green light to apply for this regime for 15 years. Okay, I hope I gave you some interesting information about it. If you want to know more, click the link in the description below the video. You can have our consultancy with our team or with me. And don't forget to subscribe to the channel, a notification bell, a like button to be always updated whenever we release for free this kind of video. Thank you, bye.